This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, I'll just quickly run around the world. We've got Salih Yilmaz from Dubai calling in, swinging around the world. I'm in 731 Lexington today, alongside Fernando Valle and Scott Levine, who are also here, although we're sitting maybe 100 feet from each other. And then we've got Talon, Custer calling in from New Jersey. So that's the crew for today. And where I think would be a good place to start, we're just coming off of 3Q earnings cycle. And if you are unfamiliar, whenever one of our important companies has something that's surprising or relevant, we put out what's called a react. And in my own franchise, we had some pretty interesting news on Vestas this morning. So go and check out our react. If you're unaware, they had a relatively good quarter, and they raise their margin guidance for the year, which is aligned with, frankly, how we've seen the company. We've got a focus idea on them, and we think they've got a pretty good path to build EBITDA margin that could beat consensus next year. So take a look at our React and our focus idea. Along those same lines, Scott, you've got a couple of Reacts out just very recently here, one on Quanta and one on Mastech that I think might be interesting and may even tie in a little bit to the story that Vestas had out this morning. And for anyone who is unaware, Vestas is the world's largest wind turbine manufacturer. So anyway, over to you, Scott, to talk earnings in your space.
Yeah, so you're correct, Rob. We had interesting news out of some of the infrastructure contractors, and both Quanta and Mastech bought renewable infrastructure companies in 2021 and 2022 and got big into the construction of wind and solar and storage facilities. And Mastech had a very rough earnings report on they ended up reporting 2 days earlier than they had planned. And that was on Wednesday, and the stock has effectively been cut in half over the last 4 months. And it's seemingly they've had a lot of trouble with the renewable acquisition that they made, which was a company called IEA, and so they cited on their call that as the primary driver of the downside, although they had weakness in other areas, such as communications and grid work. But we have suspected that they may be experiencing company-specific issues with that acquisition. Sure, there's been some impact to the renewable business, and there's been a lot of concern about that because of the rise in interest rates. And Quanta's results, which came out a day later and were fine and actually reflected strong performance in the renewable energy business, affirmed that view that Mastech's challenges there may be company specific and largely related to that deal. And maybe the one fundamental read through with the mixed results there, seemingly Mastech's customer base seems to be more dependent on tax equity financing. And uncertainty regarding the bonus incentives for U.S. components and eligibility for that on the part of project sponsors may be causing some of those sponsors to hold off on those projects and delaying some of that work. And so we'll see if that ends up materializing, and we'll also see if Mastech's able to improve the performance of that IEA unit going forward. But those were the mixed interpretations that we saw, but suggest that maybe the read-through for the industry as a whole, renewable wind and solar construction, may not be as negative as feared.
Yeah, very interesting. The very high-profile offshore wind cancellations, which has been driving sentiment in this space, I think, generally, but I don't think that that's the sort of end-all be-all if you're looking for signals. There's a lot of other stuff going on besides offshore wind off the North Northeast here in the U.S. Talon, I want to come to you because you had a react out on Kinder Morgan maybe yesterday, I believe, which I don't think was earnings focused. So tell us about that react, and also want to just get your broad read on how 3Q is going in your space.
Yeah, so the react with Kinder's the first company to report in my space, so they reported a few weeks ago. But the react was due to another acquisition, which we talked about the last time I was on this call. A common theme in the space, and they acquired STX Midstream from NextEra, and I think it's positive for them. It's whenever I look at these acquisitions in midstream, first thing I look at, especially for the companies with is their balance sheets, right? So it's $1.8 billion. It barely moves leverage, which is a positive thing, and it really, this one there is some synergy potential. It's focused in South Texas and moving Eagle Ford gas, and it really focuses on enhancing their exposure to LNG and Mexico exports for gas. So I view that as a positive, and I had written about Kinder. They've been acquisitive. We expected them to continue to be, and we anticipated that they would focus on the natural gas space, or even expanding into renewables, like renewable natural gas. They're also growing there. So yeah, another interesting acquisition, and again, not a corporate deal, a bolt-on, which again we think should continue throughout the space. And in terms of earnings, I think the common theme, the first theme that I've noted are the distribution hikes. So midstream in general is known for its income, its dividend yields, and these companies are focused on returning capital to shareholders. And I think that's even more important in the current yield environment, right? There's a lot more competition. So for example, Targa plans to increase their dividend by 50%, Plains by almost 20%. The caveat with them is that they were two that cut during the pandemic, so they have more runway. But even still, these are impressive increases, exceed consensus. And other companies, MPLX, Cheniere, they're planning 10% hikes. So it's just important where the risk-free rate now, it almost touched with the 10-year treasuries, right? It almost touched 5%. It's been between 4.5 to 5. Companies in my space yield about 6 to 9%. So there's still a difference, but it's narrowed from even just a year ago. So you really have to scrutinize the individual company, assess the equity risk premium to see if that extra yield is worth it. And real quick, one more thing is guidance raises. So nearly a third of my company's increased EBITDA guidance. I think a lot of it has to do with being conservative after what they've gone through the last few years. It leaves room for upgrades, right? And obviously they have a lot more visibility through October. But still, it is a reflection that a lot of companies' operations have been stronger than expected, and again, some of that is also due to M&A. So I'll leave it there for you.
Thank you so much, Talon. Very interesting to hear that, and I want to keep the focus on the earnings. I know we've got a lot of fun, probably oil macro and thematic stuff that we'll come to on the call as well. But let's swing around to Fernando. I think you had Delek report yesterday. Tell us what happened and sort of give us your read on some of the things going on in your corner, Fernando.
Absolutely. Another strong quarter from a refiner. 3Q is very strong for the group overall. And in Delek's case, it was a needed boost because Delek's undergoing a very long strategic review of its portfolio. It's been over a year now, where they're looking for solutions to unlock value according to management. And what this quarter did is essentially they got to a place where, excluding its MLP's net debt, I should say, the remaining segments are net cash. So they are in a position now where they could sell their stake in Delek Logistics. Now, why is that important? Is because they currently own around 77% of Delek Logistics. That 77% is worth more than the whole market cap of Delek. And so you're basically getting the refinery and the retail segment for free when you, in that equation. course, there's also, it's on an EV basis, it's still a very significant portion of that. So I think by getting to net cash, it facilitates any eventual moves that they'll do either with DKL or with their retail segment. When we look at the other companies that have reported earnings, we've had most of the majors by now, most of the refiners. Overall, it's been, as Talon said, a very positive quarter. But when you look forward to 4Q, as Rob was saying about all the interesting macro, it's certainly looking much worse. A sharp slowdown, potentially sharper than the second quarter, and importantly also, well, the companies that have chemicals in our industry, from Exxon to Chevron, Phillips, they've all reported very poor petrochemicals earnings, which again to us is a bit of a canary in the coal mine, saying that the overall use of those products, which goes hand in hand with GDP, is slowing down sharply.
Okay, thank you, Fernando. Salih, let's come around to you next. You had a react out on Aramco just the other day, also OMV. So give us the read on your space. Tell us about the reacts and what we heard in earnings.
Sure. So very briefly on Aramco, that was yesterday. Actually, I mean, as already been discussed, it was a pretty decent quarter for Aramco. No major surprises. I mean, we know that the major limiting factor for them in upstream is the OPEC plus cuts and the fact that their upstream production is limited around 9 million barrels per day. To put that in perspective, I mean, on paper, their oil production capacity is at 12 million barrels per day. So this is a significant sacrifice that they're making. But obviously, the realized pricing is still at quite elevated levels. And on top of that, you know, chemicals we knew was going to be softer. I mean, SABIC actually reported before them, so we knew chemicals margins not doing great. We knew the SABIC contribution was going to be less. But beyond that, refining margins actually ticked up in the third quarter, and Aramco benefited from this as well. So their bottom line and free cash flow actually came above consensus expectations in the third quarter. And the big talking point with Aramco is, the last couple of quarters we've been talking about, is the performance-linked dividend that they decided to start paying starting in the third quarter instead of the beginning of next year. So they made the first payment for this. And with the base dividend, which stands at around $19.5 billion, plus about $10 billion of performance-linked dividend, they actually paid out almost $30 billion in dividends. I mean, obviously, a big chunk of this goes to the government, but it is also kind of pulling their dividend yield up a little bit closer to some of the global peers. So that's Aramco. When we look at the wider European EMEA space, I mean, some of the names that you mentioned, when we look at companies like OMV, Repsol, Galp, it's a pretty similar story. In the case of Repsol and Galp, their upstream have actually done quite well. In the case of Galp, their Brazilian assets performed quite well, pricing pretty strong. So they actually lifted their guidance. In the case of Repsol, it was a pretty good quarter, and their downstream was actually quite strong as well. So they increased dividends, quite surprisingly, at least to me. And in the case of OMV, obviously with the acquisition of Borealis, they are very exposed to chemicals, and that has pulled, in contrast to some of the other companies, that has pulled their earnings performance down, and they actually missed on the consensus expectations at adjusting operating profit level. So generally what we've been seeing in the last couple of weeks on earnings, but a lot of similarities between these companies and what they've told us on the earnings calls.
Okay, Salih, thank you very much. Scott, I want to come back around to you because you've got a sort of broader ecosystem of coverage, and I think it would be valuable to just hear what's happening with some of the drilling names you cover, you know, and because perhaps a leading indicator for where things may be headed for sort of broader things in the oil space. So maybe give us the readout on the drilling names.
Sure. So, you know, we've got, we had Valaris yesterday, though the largest offshore driller by rig fleet size. We had Transocean and Noble last week, and you know, this has probably been the strongest performing subsector in my oil field services universe. And you know, the results were kind of mixed overall, I'd say. But the stock response suggests that investors remain confident in the durability of the recovery. The reason I say soft is because we haven't seen as much follow through maybe on day rate increases as was anticipated in the first half of this year. Also, we're seeing a little bit of a slowdown in activity ahead of what is expected to be an uplift by the middle of next year as some of these rigs prepare for new contracts and multi-year drilling packages. And you know, I'd say that South America continues to be the strongest area. Certainly Brazil, Guyana, and some of the other markets. The Gulf of Mexico probably a little bit weaker. Recently, I would say Mexico on the other side seems like it's relatively healthy or picking up. Australia is also picking up, but generally the results have been mixed, but the confidence still seems to be there that this is maybe an air pocket or a soft patch in what is expected to be a continued recovery. Shifting to the shale and land drillers, we have Patterson UTI out with numbers today, which are pretty good. Now, their results are a bit skewed by acquisitions they bought next year, which was the number 3 pressure pumping company that closed during the quarter, and they also bought a drill bit manufacturer, Altera, during the quarter as well. But the fundamental read through from their results suggests the drilling, their rig count is expected to increase by 3 in the fourth quarter. Suggests that we've seen a stabilization in the third quarter on the drilling side. With the fracking side, the expectation is that that will stabilize in the fourth quarter, and results were a little bit weaker in the third quarter. So maybe a 1 quarter lag between drilling and fracking, but enthusiasm in response to their results, despite the recent pullback in oil, suggests there's some good confidence that maybe we'll see drilling stabilize or drilling increase in the fourth quarter, with fracking 1 quarter behind. And the number 1 land driller, Helmerich and Payne, is reporting tomorrow, and so we'll see if there's an affirmation of that trend out of their results, and they, I think, report after the close today. So, you know, I'd say some cause for encouragement on the land drilling side and what's been probably the weakest subsector in my universe, and enthusiasm for offshore drilling, which has been the strongest sector, despite mixed results for 3Q.
Okay, thank you, Scott. Just to round out the space, I'll just quickly add, been a tough year for most of the wind and solar names. Again, as I already said, we had a pretty good readout from Vestas this morning, and despite all the headlines around offshore, offshore is for wind is at least kind of a 2030 thing, right? So if you're canceling projects, it doesn't really affect much of the near-term momentum that some of these companies have. And in solar, things are pretty bifurcated. If you're residential exposed type name, the higher interest rates have really pumped the brakes on demand. So you've seen pretty disappointing 3Q and weak guidance for 4Q and maybe into next year. If you're on the utility side, things have fared quite a bit better. So with that, I think we'll maybe just switch a little bit more to some of the macro themes. And always a random walk a bit, but it looks like Brent's about $80 a barrel and change today. WTI 76, which is quite a bit off of some of the more recent highs that we've flirted with. So Fernando, we'll start with you. What's going on in the broad oil macro space in the moment, do you believe?
Well, I've read a couple different things, and from the geopolitical risk premia coming down because we think this will not escalate beyond where it is today, to just demand finally showing its claws and or lack thereof. We tend to focus more on the second. Again, if you look at in some of the Fed governors, the recent speeches, they've talked that we are perhaps not at the end yet of the rate cycle. We've also seen autos and credit card delinquencies now above pre-pandemic levels, and all of those showing the concerns we see around the consumer and their ability to afford fuels at elevated prices. Obviously, with WTI 76 and a crack spread in the low teens, at times in the single digits, it helps significantly in the affordability side. But we're also going into a period where there is just structurally lower demand, so we won't see the full benefit of that for refiners and consequently on the crude demand. And then I'll let Salih go more into this, but Saudi confirmed that they're going to continue their cuts through year end. Nothing really new there. I mean, I would be surprised if they brought anything back before the end of the first quarter. But we'll see. That, to our view, demand continues to be the biggest driver, and I think the consumers, not just in the U.S. and Europe, but in China as well, have been saying we can't afford to pay $3.50 a gallon or whatever that translates to in Europe and China.
Salih, let's swing around to you, get your perspective on the oil macro side of the equation.
I mean, I don't disagree with any of that. I think the geopolitical risk premium, the market seems to have shrugged off most of that. I think it seems to think that the war and the conflict will be contained to the Levant region. But yeah, on demand, I mean, we're getting some indicators such as the U.S. gasoline demand that may be on its way to fall to a 20-year low next year on a per capita basis. In China, demand is soft. We've known that for a while. But one thing I will say is, especially in the second half of the year, I think we've been talking about demand and how it's been a huge overhang on prices, which it is true. I think perhaps we're not talking about supply as much, and when we do, we're talking about how OPEC Plus is keeping supply constrained. But when you look at some of the Russian shipments data within OPEC Plus, and that's come to a 4-month high now. And within OPEC, last month we saw, Saudi Arabia, the UAE delivering the cuts that they promised, but some of the African member nations, which we know have been struggling for a while to increase output at all. But we've seen some of the output levels in those countries tick up in the last month. And non-OPEC production has been going up, especially US shale. So, I mean, it is a demand story to an extent, but it's also a bit of a supply story. I think supply has been higher than where we imagined it to be when we were modeling the second half, at least so far into the third and so far into the third quarter. So again, I mean, I think the last time you asked me this question, the range bound I gave had a lower end of that range at 85. So don't ask me again because I think we're already at $80 a barrel. But a lot of moving parts, very challenging to predict, etc., etc. So.
Predicting the future is hard. We'll give you a pass. Scott, I want to come back around to you, and then Talon will come to you next. But Scott, just hearing the discussion around maybe perhaps some of the demand weakness, interest rates, how are those things feeding into the discussion around the drilling perspective? Is it such a long lead time business that none of that matters, or are some of those headwinds coming across to your names as well?
Yeah, I mean, I think like the mantra is, firstly, the answer differs depending on whether you're talking about offshore or land, right? Land is a short cycle business. Offshore is a long cycle business. And so my sense in general is that, and offshore is also a more capital intensive business. So the rate issue is probably more impactful there for sure. I'd also say that the sensitivity to the commodity price is less of an issue there in general. You know, Petrobras is probably the most important customer right now in offshore, and they are the ones that are ramping up drilling the most, and the national oil companies tend to be less sensitive to commodity price or rate fluctuations. But you know, as far as the rest of the world is concerned, I'd say that those type, you know, the rate issue is more of a factor on the offshore side, and maybe a factor in some of the pause that we've seen in terms of contracting activity over the past quarter or two. And shifting to shale and land drilling, and specifically shale, there's plenty of land drilling going on elsewhere in the world, but certainly the rig counts in the U.S., which are down about 20% year to
Anyone
date.
else? I lost you for a second. Is it
Oh,
just
can
me?
you? I'll keep going, and we'll hope for the best. How's that? But you know, on the shale side, certainly it's been a rougher year than was expected, even at the middle of the year, not just the beginning of the year, but the middle of the year. We've seen bigger declines in activity than were anticipated, and you know, certainly given where the commodity price stack has been on the oil side. And so I think that the hope here is that the business is becoming more resilient or less sensitive to short-term commodity price fluctuations, given greater efficiencies amid a healthy price stack on the land side. And the expectation is still that we'll see improvement. And even though we've seen a big pullback in oil prices, as Salih alluded to, we're still at a price level that's pretty comfortable for producers. And so I would say that the rate issue shouldn't be as much of a factor on the U.S. land drilling side. If we break much lower, though, on commodities, certainly if we breach $70 a barrel, I would expect to see a response on the part of the drillers, certainly much more of a response than we would expect to see on the offshore side. So hopefully that provides some clarity regarding both land and offshore.
Thanks a lot, Scott. And sorry to interrupt. I think my audio was the only one that was out, so apologies here.
No
Talon, I want to come over to you and get your pulse on two things. One, how are interest rates base? I'd be curious, particularly on some of the pipeline names that you cover. You know, do they matter? How do you think about them? And then maybe it would be good to sort of get your concluding remarks, maybe to think about what's going on with the LNG and the gas side of the equation, which we haven't really touched on with the call here today.
Yeah. So for rates, obviously that when you're building infrastructure, that plays a role, and you're looking at LNG projects, that has been an increasingly important topic, right? It's 20 to 30% more expensive to build, an LNG plant. And that goes into, on the U.S. side, when you're negotiating with customers, you have to, because a lot of it's structured with Henry Hub plus a premium, right? And then a liquefaction fee that's meant to cover the capital cost. And that liquefaction fee fluctuates, based on what they're going to spend, right? So a lot of them have had and tried to offer, higher liquefaction fees to guarantee a return. Some buyers understand that, some have balked. So that plays a role. And then, a lot of these midstream companies, many are, self-funding with cash flow, and they're not borrowing as much, but they do have to refinance. Even ones with strong balance sheets, they have debt maturing every year and they have to refinance, and it just, it adds interest expense, right? And cuts in the margins a little bit. And then you have one company, for example, Kinder Morgan, has a higher exposure to floating rates. So about 25% of their debt is floating rate. So that has hurt them. It's hurt their distributable cash flow this year. But overall, these projects are more expensive. On the flip side of that, given the current environment, you have a more mature E&P space, slower growth there. And then you have the regulatory hurdles. It's, borderline impossible to build a interstate pipeline anyway. So a lot of these projects are, smaller in scale. But with that said, we'll talk about the one, elephant in the room, which is Coastal GasLink. Obviously, costs for that project have skyrocketed. TC Energy maintained this morning, I think it's 14.5 billion Canadian dollars, which is significantly higher than what it was originally anticipated to be. So we've seen the rates, the inflation, everything touch that. As far as LNG and gas, I mean, Europe storage is basically full, right? But even still, prices for TTF and JKM remain elevated, much like oil. That risk premium has come down, but we've seen it's impacted Egyptian LNG exports, but it hasn't really affected anything else. But as Europe's going to keep importing LNG. They want to keep that storage as high as possible. They're going to have some withdrawals, but they want to keep bringing in as much. So I think the LNG is going to keep flowing. I think the prices reflect it. And again, the prices reflect the supply risk. Any small move or anything that could affect it just makes the prices jump, even if it is just temporarily.
Sorry, Rob, I think you're on mute.
Can you hear me now?
Yes.
All right. Thank you so much. Sorry about that. Lots of technical mishaps today. Anyway, what I was saying is, for anyone who's based in New York, come and join Fernando and I later today. If you're free around 4:30, we're going to have an in-person discussion, not just Fernando and I, but some of our colleagues. And we also want to hear what you have to say, and we'll grab some networking drinks afterwards. So shoot either Fernando or I an IB if you want to join us. And we're trying to do as much as we can in person going forward. And so I'll just flag that in late January, the week of January 29th, Fernando will be joining Salih in UAE and doing a little bit of a tour around the region. So if you're in that part of the world, you want to see either of them, make sure to connect, and we'll have some more formal details to share around some events and stuff they'll be doing in the near future. But we look forward to not just talking to you through a computer screen, but seeing you in person. And so always be in touch. Just shoot any of us an IB or an email if you have any follow-up on any of the discussion here today or anything that's in our franchise. So thanks a lot, everyone. We'll talk to you next week.